Hello and welcome. As you start your investing journey, you'll quickly find out you don't have to pick individual stocks to succeed. Two of the most popular ways to invest in a diversified portfolio are through index funds and mutual funds. They sound similar, and in many ways, they are. But the differences between them are crucial, and choosing the right one can save you tens of thousands of dollars over your lifetime and significantly boost your net returns. This isn't just a minor technicality, it's a fundamental decision about cost and strategy. In the next few minutes, we're going to demystify these two investment vehicles. We'll clearly define what each one is, break down their key differences in a simple way, and give you a clear framework to decide which one is the best choice for your money. Let's begin. Let's start with a simple analogy. Imagine you want a delicious, home-cooked meal. A mutual fund is like hiring a personal chef. You give them your money, and they actively go to the market, pick out the ingredients they think are best, and cook you a meal. You're paying for their expertise, their time, and their promise to try and make a better than average meal. This is active management. An index fund is like buying a pre-portioned, perfectly balanced meal kit from a service like HelloFresh. The kit doesn't try to reinvent the recipe. It simply contains all the exact ingredients you need to replicate a specific, well-known dish. You're not paying for a chef's opinion. You're paying for efficient, precise replication. This is passive management. Now, let's translate this back to finance. Both funds are baskets that hold dozens or even thousands of stocks and bonds. When you buy a share of a fund, you own a small piece of that entire basket. The core difference lies in the philosophy behind how that basket is filled. A mutual fund, which is typically actively managed, has a manager who is constantly buying and selling stocks, trying to pick winners and avoid losers to beat the market. An index fund, which is always passively managed, simply holds all the stocks in a specific market index, like the S&P 500. Its only goal is to match the market's performance, not beat it. So why does the chef versus meal kit distinction matter so much? It boils down to three critical areas: cost, performance, and accessibility. First, and most importantly, cost. This is where index funds have a monumental advantage. Remember the personal chef, they're expensive. Actively managed mutual funds have to pay for the team of analysts, researchers, and the star portfolio manager making all the decisions. These costs are passed on to you as higher fees, known as the expense ratio. An average actively managed mutual fund might have an expense ratio of 0.5% to 1% or even more. A typical index fund, like one tracking the S&P 500, can have an expense ratio as low as 0.03%. That difference might seem tiny, but over decades, it makes a staggering difference. Let's put it in perspective. On a $10,000 investment growing for 30 years, that 1% fee could cost you over $100,000 in lost potential growth. The index fund's low cost leaves more of your money working for you, compounding year after year. Second, let's talk about performance. For decades, study after study, including the famous SPIVA report from S&P Global, has shown a brutal truth. The vast majority of actively managed mutual funds fail to beat their benchmark index over the long term. While a few managers might get lucky in the short term, consistently outperforming the market is incredibly difficult. After you account for their higher fees, the odds of you picking one of the few long-term winners are very, very low. The index fund, by simply matching the market, ends up outperforming most of those active funds over time. It's a game of odds, and the odds strongly favor the passive, low-cost approach. Third, accessibility and minimums. Historically, mutual funds often required high minimum investments, sometimes $1,000, $3,000 or more. While many have lowered these requirements, they can still be a barrier for new investors. Index funds, especially when they come in the form of ETFs or exchange-traded funds, can be bought for the price of a single share. And many brokerages now allow you to buy fractional shares for as little as $1. This makes index funds incredibly democratic and accessible to everyone, no matter how much you're starting with. So, given all this, which one should you choose? For the average investor, the decision becomes much clearer. Choose an index fund if you're a beginner and want a simple, low-maintenance strategy. Choose an index fund if you are cost-conscious and want to keep more of your returns. Choose an index fund if you believe in long-term, steady growth, and are skeptical that anyone can consistently beat the market. And choose an index fund if you want to set it and forget it, using dollar cost averaging without worrying about a manager's performance. In practical terms, this means looking for broad market index funds or ETFs from well-known providers like Vanguard, Fidelity, or Charles Schwab. Think of funds with tickers like VU, which tracks the S&P 500, or VTI, which covers the total US stock market. Now, a mutual fund might be the right choice in a few specific situations. For example, if you have a strong belief in a specific, proven fund manager who has a very long and successful track record, though you must remember that past performance is no guarantee of future results. Or maybe you're reinvesting in a niche area of the market where active management could potentially add value, like certain emerging markets or specific, complex sectors. It could also be your best option if you're reinvesting through a 401k at work that has a limited selection of funds and the index funds offered happen to have unusually high fees. In that case, you just choose the lowest cost option available to you. But for probably 95% of you watching this, especially if you're a beginner, the evidence is overwhelmingly in favor of starting with low-cost index funds. They remove the emotion, they minimize costs, and they guarantee you will match the market's return that has been more than sufficient for building long-term wealth for generations. Let's do a quick recap. What's the difference? Mutual funds are often actively managed by a chef picking stocks, while index funds are passively managed like a meal kit tracking an index. Why does it matter? Index funds almost always win on cost and frequently win on long-term performance after fees, making them a more efficient vehicle for most investors. And how do you choose? For simplicity, low cost, and proven performance, start with broad market index funds or ETFs for the core of your portfolio. The greatest investor of our time, Warren Buffett, has repeatedly instructed the trustee for his wife's inheritance to put 90% of the money in an S&P 500 index fund. If it's good enough for Buffett, it's certainly a fantastic starting point for you and me. Don't let the pursuit of the perfect, complex strategy keep you from implementing a simple, good one. Opening an account and buying your first share of a low-cost index fund is a decisive step toward your financial independence. Thank you so much for watching, and be sure to subscribe for more simple guides to building wealth.